It has been a crazy week in the world of finance with Silicon Valley Bank failing and then Signature Bank collapsing. And then more recently, we had the former FDIC chairperson, William Isaac, come out who said, quote, "There's no doubt in my mind. There's going to be more failures. How many more? I don't know. How big? I don't know. Seems to me a lot like the 1980. So what is going on and how much worse is this going to get? Now, what I want to do is start by just kind of explaining what's happening with banks and people's deposits, because up until a week ago, we had FDIC insurance, which would insure one person's deposits in a bank up to $250,000. So if you go to a bank and you would deposit, say, $200,000, and then the bank failed, and then you weren't able to go to the bank to get your money back because they collapsed, you'd be okay, because then the FDIC insurance would kick in and they would give you all $200,000 worth of deposits back. But now what happens if instead of $250,000 you deposited, say, $2.5 million? Well, typically before this week, what would happen is FDIC insurance would give you the first $250,000 back, and then the other $1.75 million would be gone because you kept your money in a bank that wasn't very good. And so the whole idea was you as the investor, the person who's saving money, has to research the bank, has to be financially educated enough to know where you're keeping the money to make sure that your money is somewhere safe. And FDIC insurance was created because of previous bank runs. Back when the Great Depression happened in the late 1920s, you started to see people get worried about money. People were getting worried about what was happening in the economy. So people started to run to the banks and pull their money out of the banks because they were scared about banks going under. They weren't sure what was happening with the economy. So people felt safer with their money. So they pulled money out of the banks. And again, the banking system isn't designed for people to pull their money out. And that's what caused more banks to collapse. And people had no insurance then. There was no such thing as FDIC insurance. And then after that Great Depression, you saw the government freeze withdrawals, and then they created this FDIC insurance. So FDIC insurance was created because of bank runs to protect people from doing bank runs, and it protected people up to $250,000. Now, where does FDIC get their money? Because this is where things start to get really interesting. Because FDIC is a part of the government, and it is backed by the full faith and credit of the United States government. Now, interestingly, while they insure banks and they insure depositors, they don't have this huge reserves that could fund all deposits, assuming that we were to see a lot of bank failures. So what does that mean? I mean, if FDIC had to be enacted, where would they get that money? Well, like I said, FDIC is backed by the full faith and credit of the United States government, which means if you were to see big bank failures like we're seeing happening now, FDIC would pull the money out of their funds, out of their pool, and they would then use this money to pay back the depositors that lost money. But if FDIC runs out of money, they're backed by the full faith and credit of the United States government, who will then step up and give FDIC whatever funds that they need. That way FDIC can then fulfill their needs of the depositors. Now this is where things get interesting, because the government doesn't have excess cash laying around. The government isn't a full for-profit entity. They get their income from one place. Taxpayers, people like you, people like me, when we go to work, we get paid, we pay the government taxes. Now, if the government doesn't have extra tax dollars laying around, because they don't, that's why we have almost $32 trillion with the national debt. That's why the government spent $1.5 trillion more than what they brought in last year. If the government doesn't have excess cash laying around, where do they then get the money to fund excess FDIC givings? I mean, if the FDIC has to give out money, where does the government get that money? Well, the government has the ability to borrow this money from the Federal Reserve Bank. So the Federal Reserve Bank is called the Federal Reserve Bank, but they're not federal. It says so on their website. They're not a reserve because they don't keep cash reserves, and they're not a bank because you and I can't go there to deposit money. But they have the ability to essentially create money out of thin air, so that they can create this money, loan it to the government can then give it to the FDIC, and the FDIC can then give that out to depositors who lost their money. Now, what happened with Silicon Valley Bank and Signature Bank is a little bit unique, because according to the FDIC, now they're going to do something a little bit different, because the FDIC insures all deposits up to $250,000, And that is a given. But now what we saw was there was a lot of startups, a lot of businesses, a lot of people that had millions of dollars, in some instances, hundreds of millions of dollars sitting in Signature Valley Bank, in which case getting 250 grand back is like getting a penny back out of $100. Like it's not that much. And this is where the government with the Federal Reserve Bank stepped up and said that they would insure 100% of deposits instead of just the $250,000. And the way that they're going to do that, according to their press statement, is that they're not going to levy a tax on taxpayers. They're not going to use tax dollars. They want to create a special assessment on banks. Now, the real details of how this is going to be created and done hasn't been released, at least to my knowledge, yet. So stay tuned on how that actually works. But now what they're saying is that they want to levy a special assessment, a fee on banks to fund this extra money. But you have to ask, is there a limit to how much banks would be willing to pay, and who's going to front the bill for banks? Because, I mean, banks have to get their money from somewhere. They get their money from customers, people like you and me who bank at the banks. So if they have to pay a lot of money in fees, well, that's ultimately going to come down to the customer. But then if we see more and more of these issues arise, and then banks have to pay up huge fees, when are they going to say, no, we're not going to do that, or we can't afford to do that, or that we just aren't going to do it for whatever reason? Now, we kind of discussed this in Market Briefs, my free financial newsletter, because every day in Market Briefs, we're now covering what's happening in the banking sector. We have our own section for banking. In addition to the stock market, the housing market, crypto, the economy, and the global economy. If you haven't joined Market Briefs yet, it's a free way that you can stay up to date on what's happening in the financial world, and you can read the newsletter in 5 minutes or less. So if you haven't joined Market Briefs, I got the link to how you can join down in the description below. But this is where now understanding, is there going to be a limit, and who is really going to pay the price? And this is something we're going to see with time, because what we're seeing happen right now is a lot of regional banks, smaller banks, are struggling. And the reason why the regional banks are struggling is because you have people who have money in these banks saying, well, even though the government has created this new protection to protect consumers, people who deposit their money in the bank, I don't feel safe keeping my money in a smaller bank, so I want to move my money to a bigger bank that should be safer. And so you've been seeing a lot of money transfer out of the regional banks and go into the bigger banks. Now, that's putting a lot of pressure on the smaller banks. Now, to protect the regional banks, again, the federal government created a new program to allow banks to borrow money from the Federal Reserve Bank in order to stay afloat and protect their operations, as a way to essentially keep these small banks afloat. Because again, the banking system isn't designed for people to pull their money out. A lot of people are pulling their money out and moving it somewhere that they believe is safer, into the bigger banks. And so this is where now or particularly the regional smaller banks are struggling, because a lot of people are pulling their money out, and now they're using their resources at the Federal Reserve Bank to borrow extra money to stay afloat. Now, that's kind of like a life vest thrown at these regional banks, but there is a limit to how much people will be able to borrow, and there's going to be a limit to how long this will last, because then if we start to see more regional banks fail, well, that's going to create more fears, more worries, potentially more aid by the government. Who knows? We'll see what they do. I mean, the government seems to be willing to do whatever it takes to keep the banks afloat, but this is kind of what we're seeing happen. Now, of course, when you borrow money from the Federal Reserve Bank, who makes these now 10 to 20 to $25 billion loans, that money has to be printed, which is inflationary. However, the theory is that when the loan gets back, it's paid back by the bank to the Federal Reserve Bank, that it no longer is inflationary, because that money essentially you can zero it out. And what I mean by that is, again, the Federal Reserve Bank, when they loan, so this loan program, it allows banks to borrow up to $25 billion. So if a bank borrows $20 billion, the Federal Reserve Bank would have to print that $20 billion, loan it out to the bank, which is inflationary. But then if the bank pays that $20 billion back plus interest, that is no longer inflationary. So that's the theory with that. We'll see what actually happens. But this is where a lot of people are saying, should I move my money to hard assets? Now, hard assets are things like physical real estate, physical gold. I own hard assets. I own physical real estate. I own physical gold. But I also own paper assets. I own stocks. I own businesses. I mean, I have paper assets and I own hard assets. There's a time and place for both, but this is where understanding now, just kind of general psychology when it comes to investing. And I apologize for the camera angles. I just got back from LA. I haven't opened up my tripod yet. I got to figure out where that is. So thanks for bearing with me. But when it comes to investing your money, the first thing you have to understand is you got to know how to live below your means so you have money to invest. Now, when you have money to invest, the question is, where do you invest your money? And when you invest your money in real estate, you get some benefits, because now when you invest your money into real estate, you own something that you can see, feel, and touch, a tangible asset, otherwise known as a hard asset. Plus, you also get cash flow and you also get some nice tax breaks. But investing in real estate isn't accessible for everybody, and it's not very easy to do because investing in real estate has its own set of headaches. And just because you invest in real estate doesn't mean you're guaranteed. I mean, if you remember what happened during the pandemic, the government created a moratorium which said that tenants essentially didn't have to pay rent. So now if you were a landlord, you had expenses. You had to pay for your bills, you had to pay for your mortgages, you had to pay for everything, but you might not have had money coming in. So there are issues associated with all types of investing. Investing has risks, whether investing in hard assets, whether investing in soft assets, paper assets. And even with hard assets, yeah, I mean, your building can also get burnt down. Tenants can destroy your building. Sure, you can get insurance, but there's other costs and risks associated with hard assets. With paper assets, you have other risks. You have risks like, well, like we're seeing now, you can see the value of your asset get cut in half essentially overnight. You have the risk that, well, you could have a bunch of changes happen, things could change hands, your investment could get frozen, like we've been seeing happen. This is where understanding that investments have risk. And instead of making an emotional decision of saying, you know what, I'm only going to invest in hard or soft assets, understanding what is your goal for investing and finding an asset that's going to allow you to achieve that goal. Like for me, the number one goal for me is 1, investing in good assets that 2, pay cash flow. 75% of my total investment portfolio is a cash flow producing asset. Some of that is physical real estate. Some of that is paper stocks. Some of that is businesses that I'm a part of. So for me, I like cash flow. That's why the bulk of my investment portfolio is in cash flow producing assets. I also own a little bit, about 2% of my portfolio is in physical gold. Why gold? Because for me, gold is insurance against the worst case scenario situation. I don't look at gold as an investment per se. For me, it's an alternative way to save money. So I have gold kind of like as my own insurance, doomsday protection. That's something that I own. Now, the reason why, gold is not 100% of my portfolio is because gold doesn't produce more value. When you buy gold, it sits there and looks back at you, as opposed to when you, say, buy a stock. Now, the company is working to make more money. It's working to improve their value. It's working to increase their profits. It's working to do more things. The gold isn't. When you buy a rental property, you're buying the business growth in the area. Now you're looking to invest in a place where people are looking to move to. You can increase the value of the property. You can increase the landscaping. You can improve the kitchen and the bathrooms to increase the rental value. And it pays you with cash flow. Your gold doesn't. So yes, there is a value for hard assets. I recommend everybody have some hard assets, but it doesn't need to be necessarily 100% of your portfolio if it doesn't align with what your goals are. That's why before you go on to start investing your money, you got to understand what your goals are. That way you can invest your money in a way that will help you align with your goals. So that's been a big trend. I wanted to discuss that. But then the next thing that's been kind of an interesting discussion is we've been seeing more and more discussion about potential fraud at Silicon Valley Bank. The Federal Reserve Bank announced an investigation into Silicon Valley Bank. Even the Pulte family put out a tweet, which is very interesting, saying that they were going to offer $50,000 to any regular person who finds fraud or issues going on at Silicon Valley Bank. Now, the thing is, yeah, I mean, there's a good chance that there's fraud. There's a good chance that there's something bad that could have potentially happened, but unfortunately, it's too late. And this is where a lot of people have been doing finger pointing as to who is to blame. And you have some people saying, well, Congress didn't do enough oversight, or there wasn't enough regulations, or it was the regulations that weren't enough, or it's the Federal Reserve Bank, or it's the bank issues, or it's venture capitalists. And this is where I want you to understand, yes, of course we can blame fingers, and it's easy in hindsight to point fingers to say who did it. But at the end of the day, you have to be responsible for your own finances, no matter what. And in this situation, like we talk about Congress, a lot of people have been saying, well, why wasn't Congress involved more? And some people say it's because some regulations were pulled off. Some people are saying it was too much regulations. The way that Silicon Valley Bank in particular got caught wasn't because of regulators. Silicon Valley got caught because of Moody's. The regulators had been working with Silicon Valley Bank. Treasury Secretary Janet Yellen essentially said that, this is before the bank collapsed, that Silicon Valley Bank was already on their radar. They were worried about Silicon Valley Bank. And then when Moody's, which is a private company, they are a credit rating agency. They were inspecting Silicon Valley Bank, and because they opened the doors about issues at Silicon Valley Bank, that's when the whole word got out. And when that word got out from Moody's, investors and venture capital firms heard. And then venture capital firms said, we're pulling our money out and we're advising all of our companies, all of our investments, all of the businesses that raise money from us to pull our money out. And so, people are saying, well, why did they do that? Because they asked people to pull their money out, the bank failed. Well, that's like shooting the messenger. If a venture capitalist hears that a bank is struggling and they tell their investments to pull their money out of this risky bank, they heard some bad news, and so they wanted to protect their investments. And so we can point fingers all day long, and hopefully we can figure out how to prevent things like this from happening. But this is going to create a lot of debate, a lot of waste that's going to go into trying to figure that out, instead of actually now focusing on how does an individual make a sound investment with their money. Now, of course, there's some things that happen behind the scenes. You don't know what's always going on behind the bank doors, which is very unfortunate. But what we can do is learn how to make smarter investments with the money that we do have, which is where the financial education comes into place. And that's one of the reasons why a lot of people have been moving out of regional banks into bigger banks, with the hope that now, because of what happened, I want to be able to protect my money, move my money somewhere potentially safer. Now, the last thing that I want to mention has to kind of do with the housing market, because what we've been seeing happen is, since the bank failure, we saw mortgage rates fall quite a bit. And the reason why is because there's two factors that affect mortgage rates. One is the federal funds rate, and the second is really treasury bonds and bond yields. And inflation, the inflation report came out this morning. It came in kind of in line with expectations that headline CPI inflation is 6%. So it's still very high, but in line with where they expected it to be. And then core inflation came in also right in line with where expectations thought it would be. It was slightly a little bit higher month over month than what was expected, which shows that inflation is still around. And the reason why inflation is a big deal when it comes to something like, say, mortgage rates is because of something called the risk-free rate. See, if you were to lend money to the government through a treasury bond, which anybody can do, that is considered the risk-free rate in the financial world. Why is that called the risk-free rate? Because the government has always made its payments. And so the whole idea is, if you loan your money to the government, you're backed by the full faith and credit of the United States government. The government will always have money to pay you. This is what they teach in every finance book. And so because the government will always be able to pay you, because they can always print money, because they can always pay you, it is considered a risk-free investment, because if the government says they're going to pay you a 5% interest yield, you're going to get that 5% interest. Now, when the whole Silicon Valley Bank thing happened, we saw bond yields fall, partially because everyone says that this is going to be a reason for why the Federal Reserve Bank is going to stop raising interest rates. This is a reason for more stimulus, more quantitative easing to happen, to no more no more of this inflation fight because of this bank failure. That was kind of the consensus, at least for the first 48 to 72 hours after Silicon Valley Bank failed. And so because of that, we saw a lot of people move their money into bonds. What kind of bonds? Treasury bonds, particularly, because that's the risk-free investment. And the way that treasury bonds work, I know this is kind of a lot of information, but the way that treasury bonds work is you have bond prices and bond yields. The bond yield is the interest rate that the bond pays you, meaning the interest rate that the government pays you, and the price is the amount of money you have to pay to purchase the bond. Now, bond prices and bond yields are inversely correlated, meaning when bond prices go down, interest rates go up. When interest rates go down, bond prices go up. And so as we saw a huge flood of money into bonds, looking for a safe investment, especially as banks were failing, we saw bond prices go up, right? Supply and demand. As we had more buyers come in, the price of bonds went up, causing the interest rates on bonds to go down. So what does that mean? Well, as the interest rates on these treasury bonds, the risk-free rates go down, that also puts downward pressure on mortgage bonds, mortgage rates, because mortgage rates have to be higher than treasury rates, because if I'm loaning money, if I'm trying to make an investment and I can decide between loaning my money to the government or loaning my money to make mortgages, I would expect to get a better return for my investment into the mortgage market than the bond market to the government, because, well, the government is a risk-free investment. Higher risk, higher potential return. So if I'm going to get a guaranteed return of 5% from the government, I better get at least 6% if I'm going to loan money into the mortgage market. So now, as we saw a huge flood of money into the bond market, bond prices started to go up, causing bond yields to go down, and that gave some breathing room to the mortgage market. And now today we did see mortgage rates jump up a little bit, but this is where now you have a lot of people saying that this is going to help the housing market, because now it's going to cause a little bit of breathing room. If the Federal Reserve Bank doesn't stay as aggressive now on their interest rate hikes, then that is going to push more people to go and buy homes, because people want to take advantage of the lower than expected mortgage rates, and so that will make housing more affordable, and because housing more affordable, people will be able to go out and buy a home. Now, what we really need to pay attention to is what the Federal Reserve Bank does next week. The Fed is going to meet next week, and then they're going to decide what they want to do with interest rates. And before, let's say 5 days ago, before the whole Silicon Valley failure, it was kind of general consensus that the Federal Reserve Bank was going to raise interest rates by around 0.5%, 0.5%. After the Silicon Valley collapse, that really kind of cratered. Then people said that the Fed is not going to raise rates. Then they said they're going to raise rates by maybe 0.25%. After the inflation report that we just got, it looks like inflation is still very high. It isn't higher than expected. It was kind of in line with expectations. So now there's a lot of uncertainty as to what the Federal Reserve Bank is going to do. The consensus, the kind of general economic consensus, and we'll see what actually happens, is that the Fed will raise interest rates by 0.25%. That's kind of the general consensus. But the question that everyone has is, what is the Fed going to do next? And that's what people are really going to be paying attention to, because a lot of people are saying that maybe the Fed will raise interest rates one more time, but this is really going to be it, because we're seeing the effect in the banking sector. But the real words that you want to pay attention to in the Federal Reserve Bank's next meeting is, what does Jerome Powell and the Fed have to say about the banking failure and how that would impact interest rates? Because if Jerome Powell says we are keeping an eye on what's happening in the banking sector and we are going to adjust interest rates accordingly because we don't want to create a credit crisis or a banking crisis, then that shows that they might pivot if we see more economic pain. But if Jerome Powell says, yes, we saw the banking failure, but the government did the right thing by protecting them, but we are not going to change our path based off of what's happening in the banking world, and we're not going to change our path based off of what's happening in the economy right now because unemployment's still low and inflation is still high, then that gives a lot of fuel, or kind of the indication that interest rates are going to go higher. And if we get the indication that interest rates are going to go higher, then that could push kind of a lot of confusion into the markets, because I think a lot of people in the markets believe that the Fed is going to pivot. However, the inflation problem is still here. And I've been talking about this for a long time, but fighting a recession is painful. However, fighting a currency crisis or an inflation crisis can be even more painful. And if we don't put in the work, and if we don't go through the pain to bring inflation down right now, it is going to be significantly many multiples times more painful to bring inflation down when it gets out of control. And this is the big dilemma and the big debate now that the Federal Reserve Bank is going to have to make, because what we've been saying is something is going to break. Either the economy is going to break or inflation is going to break. Now, the economy almost broke. If the depositors weren't bailed out, we would have seen a lot of startups completely collapse this week. But, the government came in and kind of stimulated, and they kind of bailed out the depositors. But the economy isn't out of hot water. I mean, we still have interest rates significantly higher. We have a lot of debts that are brewing. We have a lot of debts that are building. We have interest rate payments that are going up, and inflation is still high. And now the Federal Reserve Bank is going to have to make a decision on which fight that they want to fight. And if they make that decision that they don't want to continue fighting inflation, you will see a short-term boom, especially in the markets, because it's going to create a boom in the economy, because everyone's going to assume that these higher interest rates, the economic slowdown is over, but then eventually inflation is going to get worse. But if on the other side, the Fed comes out and says, we're going to stay true to the inflation fight. It doesn't matter what's going on with banks. It doesn't matter what's going on with the economy. We got to get inflation down. That is going to be painful in the short term. And that would probably shock the markets. And that would shock a lot of people. But the reality is that would cause pain now, but less long-term pain. And this is where we got the inflation report now. The next thing that you really want to pay attention to, and what a lot of people, especially in the financial world, are holding their breaths on, is what the Federal Reserve Bank is going to say next week. Now, we'll be keeping you posted on market briefs, because every day we do a breakdown of what's happening, that way you can understand what's happening. So if you haven't joined market briefs, go to briefs.co, or I got the link for you down in the description. I'll also be working to keep you updated here, but I also want you to understand this is where the financial education aspect is so important, because my goal is for you to be able to analyze data yourself. Most of the financial news and media outlets out there are providing their own analysis based off of their interpretation of the data. I want you to be able to understand the data and then come up with your own analysis, because somebody can look at the economy right now and say the economy is booming, which is what we've been hearing. Why are they saying the economy is booming? Because people are spending. But now if you dig a little bit deeper, you look at the data and you'll see, oh, yeah, people are spending. But why are they spending? Well, people are spending because inflation is so high. So they're being forced to spend. And how are they spending? Well, 4 out of 10 Americans are digging into their emergency funds. And we're seeing a lot of Americans go deeper into credit card debt. Credit card debt has broke a new record high and is growing at some of the fastest rates ever. And our savings rate, our personal savings rate, is near an all-time low. So yeah, people are spending, which some people interpret the analysis to mean that the economy is fine. But other people, like what I'm saying, is if you understand all the data and put it in context, it kind of looks like now that there's more issues that are going to be coming. And that's why I keep saying you have to keep your eye on what the Federal Reserve Bank is doing, because next week when the Federal Reserve Bank comes out to speak, it is going to set the tone for where the economy is going to be headed. Because if the Fed says, forget what's happening in the economy, we got to get inflation down, you can expect more economic pain. This is why I want you to really build a financial education to, one, understand what's happening, which is what we're talking about, but then also second, to know how to live below your means. This is not the year to finance a new truck. This is not the year to go out and spend money recklessly. This is the year to live below your means. This is the year to build your savings cushion. That way, in case something bad happens to your job, you have money to fall back on. And this is the year to start building that cash, to build and money to invest. If you're not already investing, start learning about how to invest, and then also put some money aside to start investing. That way, when you see good opportunities, because the reality is market crashes and recessions create more millionaires than any other time. Why? Because when you see pain in the economy, you see assets go on sale. You'll see good assets go on sale. But you have to be able to identify what the good assets are. You have to be able to purchase some of these good investments, and you have to know how to analyze and research these investments. But you can't do that unless you have the right financial education. And this is why I keep saying I want you to build that financial education, whether you watch my videos, you watch somebody else's videos, you read books. There's a ton of content on the internet. Start watching the content for free. If you like that free content, maybe invest in a class, maybe read some books. Go out and keep investing in your own financial education, because that's going to pay off many times over, because a decade from now, you're gonna see a whole new wave of millionaires that were born out of whatever's gonna come out of the next few years. And you wanna be one of the people that can not only see the opportunity, but also capitalize on the opportunity. And that starts by first understanding what's happening, second, having the financial education, and third, being prepared to actually take advantage of the opportunities that come your way.